It was the largest bankruptcy in U.S. history, and it triggered a financial collapse that affected millions worldwide. In 2008, Lehman Brothers, once the pinnacle of investment banking, fell to its knees, losing over $600 billion. But what went wrong? How did a multi-billion-dollar corporation go from top tier to zero? And who were the real criminals behind the scenes? In 1850, Lehman Brothers started as a small dry goods store in Alabama. By the 20th century, it had transformed into one of the most respected and influential investment banks in the world. By 2007, Lehman Brothers was worth nearly $60 billion, a key player in global finance, with interests spanning real estate, mortgages, and securities. On the surface, everything looked perfect. Lehman Brothers was sitting pretty in a booming economy. They had major clients, a respected brand, and were known for their aggressive expansion and profitable trading strategies. But beneath the surface, things were starting to unravel. Lehman Brothers, like many other financial institutions, was heavily invested in subprime mortgages, home loans offered to borrowers who had poor credit histories. But here's where the problem began. In the early 2000s, Lehman Brothers had started taking massive risks with mortgage-backed securities. These were essentially bundles of subprime loans sold to investors, risky bets that paid off when housing prices continued to rise. But housing prices began to fall in 2006. The market slowed, and the subprime mortgage crisis began. Lehman Brothers was sitting on toxic assets, billions of dollars in bad mortgages that they couldn't offload. But they didn't stop there. Lehman continued to take on more debt to cover their growing exposure. They borrowed heavily to fund their investments, using financial instruments like collateralized debt obligations, CDOs, and credit default swaps, CDS, to obscure the extent of their liabilities. And by 2008, the company's risk was out of control. Lehman's leaders, CEO Richard Fuld, in particular, were determined to keep the company afloat. But they needed to hide the truth from investors, regulators, and the public. To do this, they relied on accounting tricks. One of the most notorious was called Repo 105, a method used to temporarily remove debt from Lehman's balance sheet at the end of each quarter. This allowed Lehman to appear more solvent than it actually was, giving the illusion of financial health. The company would borrow money, move it off its books for a short time, then return it after the quarter ended. It was deceptive accounting, and it worked. Investors believed Lehman was solid. Credit rating agencies continued to rate them highly. But the reality? Lehman Brothers was drowning in debt, with over $600 billion in liabilities. In March 2008, Bear Stearns, another major investment bank, collapsed after its risky mortgage bets failed. The financial world began to panic, but Lehman Brothers' leadership refused to accept reality. By September 2008, the market had turned. Housing prices continued to fall, and Lehman could no longer sell off its bad assets. Credit was tightening, and nobody wanted to lend to Lehman anymore. Then, on September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in U.S. history, and it sent shockwaves through the global financial system. When Lehman collapsed, it wasn't just about the $600 billion they owed. It was about the global contagion that followed. Banks no longer trusted each other. The stock market plummeted. Investors lost confidence. People lost jobs. Countries plunged into the Great Recession. The U.S. government had to step in with massive bailouts for other banks and financial institutions. But the damage had already been done. The world's financial system was forever changed. Lehman's bankruptcy also exposed a devastating truth. The system had been built on a house of cards. Massive corporate greed, poor regulatory oversight, and a willingness to overlook risk had brought the entire financial system to its knees. At the heart of Lehman's collapse was Richard Fuld, the company's CEO. Fuld had long been a champion of Lehman's risk-taking approach. He ignored warnings from analysts, regulators, and even his own team. In 2010, Fuld testified before Congress about the collapse.
Did we do everything right? We clearly did not.
He was questioned about his role in the company's failure, but he denied any personal responsibility. He blamed the market and the broader financial crisis, never admitting to the errors that led to the crash.
Nobody, including me, anticipated how the problems that started in the mortgage markets would spread to our credit markets and our banking system, and now threaten our entire financial system and our country.
But Fuld wasn't alone. Many Lehman executives were accused of self-dealing, taking massive bonuses while the company was failing. The board of directors also faced scrutiny for allowing Fuld to lead the company into ruin. Today, the Lehman Brothers collapse remains a symbol of financial greed and corporate negligence. It changed the way we view corporate accountability, regulation, and risk management. In the aftermath of Lehman's collapse, the Dodd-Frank Act was passed in the U.S., implementing stricter regulations to prevent another financial meltdown. And Lehman Brothers bankruptcy also forced the financial world to rethink its approach to too big to fail institutions. But for many, the scars of 2008 are still fresh. Millions lost homes, jobs, and savings, and the trust in the financial system is still being rebuilt. This is Fraudify, where we unmask the world's biggest scams. Don't forget to like, share, and subscribe to Fraudify for more.